PowerPoint lecture. Okay. Today we start going to chapter 2, accounting for business transactions. Okay. First, I hope everyone's doing well and the class is going well for them so far. Okay. Make sure to be keeping up with all your assignments. Again, we talked about last class, what accounting is about, how we identify, analyze, and record transactions. Today I want to talk about the steps and process of transactions and the big role of source documents. Okay, this process of transaction without some source documents. These are all very important objects here. Now remember, each transaction here, the starting points. You identify each transaction from the source documents. Review it. Is it accurate? Is it real? Is it fraud? We want to, next part, record in the journal. You go to the last part, prepare and analyze the trial balance, and of course, the last part, all the financial statements. See how the company did. Where are we? Where are we going? Okay, now we look for what is a source document. Remember, each time you do any transaction, you got to have your source documents. Your source documents are anything that can be attached to the, when you do a transaction. Any bank statements, purchase orders, bills, suppliers, anything. Okay, remember, don't just have any transaction. We need source documents because we have to prove, is it real? Or did it really happen? Again, what is an account and transactions? An account we talked about, it shows all the increases, decreases. What happened with that specific account? Now, what is any specific asset, liability, equity? And again, where they all go? Well, the big one is, of course, the general ledger, all the account. What accounts does the company use? A record of all the accounts used by the company. Everything. Again, we split up. What are our assets? What are our liabilities? Where is everything? Okay, where does it all go? And of course, the last part of equity accounts. Again, what is an asset? Remember, an asset is any economic resource. What is an economic resource used by the company? An economic resource that brings it benefits. Of course, the most popular one, cash. But don't think about cash as just your paper bills and coins. It includes everything. How much you have in your checking account, savings account. Account receivable means money that's owed to you for a transaction you complete on credit. A notes receivable is just if you got a loan back, the principal only. A prepaid account is when you prepay for an expense in advance. Okay. Supplies, equipment, just regular things, land, buildings, and so on. Liabilities, all the company's debts and obligations. Okay. What do we owe? Such as accounts payable. Those are for your monthly credit transactions. Okay, so everything you buy on credit. So, okay, what do we buy on credit? What do we owe? A notes payable is, when we got a loan, the principal only. How much principal do we owe on that loan? Okay, unearned revenues, when we receive payment before fulfilling an obligation. And last part, accrued liabilities means we record liabilities as they're incurred. It means now we owe them. And equity, that's your claim to your assets. Obviously, the big one, your common stock. Common stock says, what's your ownership of the company? Do you have any stock in the company? A dividend. A dividend is, what owners receive. If you own stock in a company, it says, okay, here's what, for each share you have, you might get $5 or $10 back. And expenses, all the costs of doing business. And of course, revenues is what we earn. Again, we look at differences here. Remember, all of our asset accounts, liabilities, equity. Where does it all work? Again, the whole point is we want to classify them properly. Now, a ledger shows all the accounts. What companies does the company use? Obviously, and again, if you notice, all of them have a number. All assets begin with 1, liabilities 2, equity, 3, and so on. Now, each account will always have a number attached to it. So, okay, bring up account number this. Again, it's asset, liability, equity. Remember, some key terms to remember here. Prepaid is always an asset. Prepaid receivables are always assets. Payable and unearned is always going to be a liability. Now, 2 key words here, debits and credits. Remember, every time you do any transaction, you're always going to have at least 1 debit and 1 credit. And it all flows together. The T account is going to show, see top middle of the T account title. Okay, is it cash? Is it, accounts payable? Whatever it might be. Okay, And on the left side, it's always going to be debits. On the right side, it's always going to be credit. Okay, remember that. That's always going to be the rules there. Now remember, these are your key things you have to know in accounting. Okay, it's assets equals liabilities plus equity. That doesn't change. Remember, assets always increase with debits. That means all assets have to have debit balances. And whatever it increases with, that's normal balance. That means all assets have to have debit balances. Liabilities all have to have credit balances. They increase the credit, so they will decrease it. And equity is the same as a liability. Remember, equity would be a little bit, we're going to split it up here a little bit. Okay, common stock and revenues increase with credits. They decrease with debits. Common stock and revenues have to have credit balances. Dividends and expenses decrease with credits, but increase with debits. They have to have debit balances. Okay, now again, these are your key accounting rules. Remember these. Every time we do any transaction from this point on, and all of accounting 211, even 212, it all comes back to our debit and credit rules. Okay, remember these. Now, take a picture here. Remember these. These are all very important here. Now remember, here's an example of a T account. We talked about it earlier. Okay, so it says right here, remember cash for example. Cash says okay, debits will increase it. So we see here, take your total debits minus total credits. That will give you your cash balance. Credits will decrease it. Remember, cash is an asset. That's how we get the balance here. Hey, an example here. Here's, take a look at this. It says right there, what's the normal balance for each account? It splits up our assets, liabilities, and equity. Remember, what's gonna, what a debit does, to either increase or decrease, like an asset. Debits increase it, credits decrease it. Assets have debit balances. Remember, these are your fundamental rules. These are very important here. I stress these very much. Now, how are we going to record transactions in a journal and post entries to a ledger? Again here, let's start the first part. Okay, so it says, all right, we'll take a look at our source data, identify transactions, analyze them, record the journal entry, then post. Remember, posting means you put them to your ledger so you can see the balance. Okay, so let's take a look how they all work. Let's start the first part. First part, you always want to start with, obviously the date, and you want to keep it in chronological order. That's very important here. Okay, it says, all right, then the title of the account's affected. Now, you always want to put debits first, then credits. So even if you have several debits and one credits, always put debits first. And remember, you always want, obviously, each transaction's total debits have to equal total credits. That's case closed. Okay, that's always going to be the rule there. All right, and if you notice here, when you start to list your credits, you always want to indent, then list your credits. All right, and if you notice here, and at the very, under the credit, give a brief explanation. You don't have to give a whole long, drawn-out explanation. It just says, take the first, for example. Received investment by owner. That's it. We're not getting to some long, drawn-out explanation. All it says, okay, received investment by owner, debit cash $30,000, credit common stock $30,000. That's it. Again, if you want to do it as a T account shows it all here. T account says, okay, take an example for cash. Remember, debits increase cash. Credits decrease it. So I said, okay, what's your balance for cash going to be? Well, it started at $30,000. It went down, the credits. At the end, I had $4,200. That's my balance for cash. It's very important because now I can see, okay, how much is my cash balance? And we post them. Remember, post them like it says there. But it says, all right, bring them down. And after you do this transaction, bring them down so you can see what's your balance for each account. If I say, what's my balance for cash, common stock? Analyze the impact of transactions on accounts and financial statements. Again, these are your rules you have to actually follow here. It says, okay, then by transaction, analyze it, record it, and post the entry. Again, we talked about it earlier. If you look at it as the accounting equation, so all right. We're not, when you do debits and credits, we're not saying positive, negative. So okay, what increases it, what decreases it? Because all right, cash went up, common stock went up. Cash is an asset. Cash increases with the debit, so we're going to debit cash. And of course, common stock is also That's equity. Increases with a credit. You can bring them over, and it says right there, all right, here we are. That's our balance for cash. That's our balance for common stock. Bought supplies for cash. They're both assets. But remember, cash supplies is going up, but cash is going down because we used to buy them. Now, bought equipment for cash. Same thing. Equipment's an asset. Equipment went up. We used cash to buy it. So, of course, cash went down. One asset went up. One went down. You follow the rules of assets. Continue on. Now you buy supplies on credit. Credit. When you buy something on credit, remember, that's going to be a liability. That's going to be a accounts payable. So again, liabilities increase the credit. So that's why you want to credit supplies with supplies an asset. So you want debit supplies to increase it. Again, after we do the transaction entry, and if you notice, there's no dollar signs in the between the 7,100 because it's assumed that everything's done in dollars and cents. So we don't need to put any dollar signs. Now provide services for cash. So here it says flat out. All right. It says all right. So we increase cash because we received cash. Cash is an asset, increases with a debit. So we're going to increase cash, and of course revenues. Revenues increase the credit, so we're going to increase that with a credit. If you notice cash, keep the running balance going. Now you bought expenses for cash, or payment of expenses. So again, you had to pay off some expenses. So it's all right. Remember, expenses, you want to increase that. So you want to increase it with a debit. And of course, cash went down because, you had to use cash to pay for it. Same with expenses. Every time you pay expenses, you always want to debit the expense to increase expenses, and then credit cash because, cash is going down. And in this case, you had to pay your salaries. And that's fine too. So you got to pay your salaries. Now it says, all right, what happened here was you provide services on credit. That means you did the job, you didn't get paid yet, and that's fine. Remember, we talked about earlier, that's an accounts receivable, it's an asset. So the receivable doesn't go up. And revenues, you earned it, even though you didn't get paid yet, since you earned it, you can record it. Revenues increase your credit, so you want to increase that. Now, receipt of cash. So, okay, cash is all right. Now, receipt of cash on accounts. Again, cash went up here because you actually received cash. So this cash went up. The receivables went down. You want to decrease that asset because, the asset's going down now because it's being paid off. So we see the balance there. People paid off. That's why I say sometimes we make a payment on account, we're going to credit your account. And with payment of accounts payable. So now it says, all right, I paid off my accounts payable. At least I'm paying it down. Remember, accounts payable is a liability. You want to decrease that account as you're paying it. So how do you decrease the liability? It goes back to our rules. Liabilities decrease with debits. But cash also went down because you use cash to pay for it. So you want to credit cash because it's an asset. Cash dividend. Remember, dividends takes away from equity. So you want to debit dividends. And of course, you use cash to pay for it, so you want to decrease cash, so you want to credit cash. Now it says you got paid for future services. So it means you didn't do the job, you got paid for it. Well, you can record cash because you actually received the cash. Except you didn't do the job yet. So you have a liability here. That's an unearned revenue. So they're both going up, but different kind of accounts. Cash went up because, you received cash. You want to increase cash. So cash went up. The liability went up because, Well, now you owe this. You have unearned revenue here. It means, well, I owe this person. A good example, such as when you buy a concert ticket or an airline ticket. You buy it in advance. When you buy it in advance, well, that company now, they have an obligation to you. They have to show you that concert. They have to fly you to wherever you might be flying to. Now, you paid for insurance. Remember, a lot of times insurance says you don't pay month to month. You have the option if you want to. You can pay if you want to 6 months or a year in advance. That's fine. A lot of them do that. So now it says you paid for in advance. So it says, all right, you paid for in advance. So now it says you have, prepaid insurance. You have prepaid insurance now for, in this case, it's going to be a 24-month policy. So again, you have an asset now. Okay, so your asset's going up there, prepaid insurance, but you use cash to pay for it. So you want to credit cash, is that one down? You had to pay your company, State Farm, Allstate, whoever you might be buying from. Now you bought supplies for cash. They're both assets. One asset's going up because you bought, obviously, supplies, but cash is also going down because you had to use cash to pay for it. Again, we talked about earlier, expenses. You always want to debit the expense, credit cash. So one expense is going up. You had to pay utilities here. And you want to credit cash, the cash is going down. And same with expenses here. Obviously, companies have many expenses. Some salaries, utilities, to rent, and so on. Again, debit and credit rules. And after we do all these debits and credits, we see the balance for each account. Again, take an example. There's our cash balance, $4,275. Receivables, remember we had it got paid, so it's zero now. Supplies, prepaid insurance, and so on. Now remember, if you notice, if you add up all of our assets, they will always equal liabilities plus equity. Example 1. So we see here, invest $4,000 cash in a company. Hey, if you look at the accounting equation, we analyze it. Okay, we know it's in balance. Next part, record it. Now our date, debits first, credits next. Always goes back to, like it says right here, all right, debit and credit fundamental rules. Next part, we post it. You have the balance for each account. Now you have about $2,000 equipment on credit. Means again, you got the equipment, except you haven't paid for it yet. Remember, when you buy stuff on credit, it says, okay, all right, now we owe it. We have an accounts payable. It says right here, I owe this amount, obviously $2,000. Now it says, provide $540 service for a client on credit. So it means you went to the job and you didn't get paid for it yet. So it says, all right, that's fine. But in the meantime now, what you did was you had an asset. It's called an accounts receivable. We have a receivable now. We expect to receive this $540 from our client. And you can book revenue because you've actually earned it. Even though you get paid for it, that's fine. But since you've earned it, that's okay. Now after we do all of our accounts, do all the balance for each account, let's look at the trial balance here. Trial balance, that's the next step. After we get the balance for all the accounts, we want to list all the accounts. Again, it should prove that debits equal credits. Here's an example of trial balance. It says, okay, get the balance for all of our accounts, all of our assets, liabilities, and so on. And you want to follow in order here. If you notice, we start with our assets, then our liabilities, common stock, dividends, revenues, and then, of course, we end up with expenses. Now, again, if you notice, another reason why we do this is because we want to verify. Okay, we see total debits equals total credits. And we know, okay, at least we know on the same page here. And another reason why we have, the trial balance again, if they didn't equal up, something might be off here. Maybe somebody made a mistake. Maybe someone's committed fraud. Again, after you do a trial balance, now the next part, ready to do our financial statement. Says, okay, financial statement says, all right, we have the balance for all of our accounts, cash, so on. We could do obviously, our financial statements from all the transactions. Again, a little review here. Remember, income statement, that shows revenues minus expenses for a period of time. Did you have a net income or loss? Remember, net income is another word for profit or loss. Retained earnings, how did equity change over a period of time? Changes in equity, net income, any other investments, withdrawals. Balance sheet, what's our financial position at this time? That's good liabilities plus equity. Okay, and again, the last part, statement of cash flows. Just for now, just remember it shows all the cash inflows and outflows for a period. And we always want to do them in order. Start with our revenues minus expenses. For income statements, it's okay. For the month ended, what was our net income, our profit? Next part, statement of retained earnings. That's why we do them in order, because if you notice, we need our net income to complete our statement of retained earnings. It comes down here. Then we need retained earnings to be for the balance sheet. Now remember, the balance sheet is a little bit different from the other statements because the balance sheet says it's for a certain date and time. The other one said for the month. And the balance sheet assets have to equal liabilities plus equity. And if it's not equaling, either someone made an error or is a fraud being committed. Any presentation issues, obviously some certain presentation here, they should have done in proper order and sequence. Again, there's a trial balance here for Apple. So we see right here, off the bat, okay, trial balance, we followed here, we see debits equals credits. It's also a good snapshot, says, okay, before you even do your statements, how much cash do we have? What's our receivables? What are our revenues, expenses, and so on? Again, we look at debt ratio here. Yeah, total liability equals total assets. How much debt does the company have? Higher ratio, of course, probably will not be able to pay its debt. You want to keep that low. Again here, monitor it over time. We see here it gets a little bit higher. You may be a little concerned here. Say, okay, what's causing it to get a little bit higher? All right, class, everyone's doing well. Let me know if anyone has any questions. Okay, thank you.